Welcome to the Evolution Studio Works podcast series. Today's conversation explains the fundamental distinctions between public and private companies. It clarifies that public companies issue shares to the general public for trading on exchanges and face stringent financial disclosure requirements from the SEC, which aims to protect investors. Conversely, private companies are owned by a limited group, do not offer shares publicly, and have fewer disclosure obligations, granting management more autonomy. Finally, it highlights the various reasons and potential risk associated with a company transitioning from public to private ownership. Let's join the conversation.
Have you ever been, scrolling through the news, maybe seen a company's stock ticker fly by?
Or heard about some startup suddenly getting this huge investment.
Exactly. And you kind of wonder what actually makes a company public or private, and why should I even care?
Right. It seems like just jargon sometimes.
Well, welcome to the deep dive. Today, we're peeling back the layers on just that. Company status. Yeah. Our mission really is to figure out the core differences between public and private companies. We'll also trace the journey, which can be pretty complex when companies switch between these states, and ultimately try to grasp the strategy behind these massive decisions. We're diving into a briefing doc and a step-by-step guide that you shared with us, so let's get into it.
Yeah, absolutely. And for you, the listener, getting these distinctions is, it's pretty critical. It helps make sense of almost every business headline, every market shift you read about. Like you said, it's not just financial terms. It's really about control, transparency, access to money, all things that fundamentally shape how companies actually work.
Okay, let's unpack that then. At the most basic level, what's the real difference? Public versus private?
It really boils down to ownership. Who owns the company and how are the shares handled? Mm-hmm. So a public company, its ownership is spread out, dispersed among the general public through shares of stock. And crucially, those shares, they're bought and sold openly on an organized stock exchange. Anyone can potentially buy in.
Like a big open market.
Exactly. Now, private companies, they're different. Ownership is much more concentrated. It's usually held by, say, the founders, the managers, or maybe a small group of private investors, think venture capital firms. Mm-hmm. And their shares, they aren't available to just anyone. They're not traded on public exchanges, period.
Right. So it's definitely not just a label. It really dictates how the company operates, who they answer to, how they get funding.
Absolutely. That core difference immediately leads to another huge split.
Which is?
The level of financial transparency and regulatory oversight. They're worlds apart.
Okay. Yeah, that sounds like a big one. What kind of regulations are public companies facing?
Oh, it's far more rigorous. Mm-hmm. In the U.S., they have to register with the Securities and Exchange Commission, the SEC. And that's not just a one-off thing. They then have to file quarterly earnings reports, constantly provide other, important info to shareholders and the public.
Quarterly? Wow.
Yep. And these rules are there specifically to protect the public, help people make informed investment choices, and it's ongoing. As long as they're public, that compliance burden never really stops.
Sounds like living in a fishbowl almost. Constant scrutiny, endless paperwork. How does that compare to private companies?
It's a really stark contrast. Private companies, they generally don't have to disclose their financial details publicly. They usually don't need to register with the SEC either unless they grow to have a lot of shareholders.
So what's the upside for them?
The key advantage really is control. The leadership in a private company has way more control. They're less beholden to what public shareholders might want quarter to quarter. And that gives them much greater operational flexibility simply because there's less external scrutiny. They don't have that pressure of the quarterly earnings call dictating strategy.
Yeah, I can definitely see the appeal of that freedom. Okay, so knowing that, let's talk about the big jump. Private to public, that's often seen as the big goal, right?
Yeah.
Especially for startups.
It often is, yeah. And the most common way to do that is the IPO, the initial public offering. Essentially, that's when a private company sells its shares to the public for the very first time. They do it in exchange for cash. But it's a really, really meticulous process. Lots of legal hurdles, significant costs involved. It's not simple.
Okay, here's where it gets really interesting. We hear IPO all the time, but breaking down the steps shows just how involved it is. What's step one for a company thinking about an IPO?
Right, they start with what you'd call assessment and planning. It's serious homework. They have to honestly evaluate their readiness. Are their finances stable? Do they have real growth potential? Is the management team strong enough? They also need to pick their method. Is it a traditional IPO? Or maybe something else, like a direct public offering, maybe a SPAC.
SPACs have been in the news a lot.
They have. And then, critically, they assemble their A-team. You need a good securities lawyer, a top accounting firm, an experienced investment bank. Plus, all their financial statements have to be reviewed, brought up to GAAP standards, generally accepted accounting principles. That financial prep is vital for building trust.
Okay, house in order, team assembled. What's the next big step with the regulators, the SEC?
That's the filing with the SEC. They have to draft and submit this huge, comprehensive document. In the U.S., it's often Form S-1. It details everything: operations, financial condition, management, risks, you name it. Then the SEC reviews it. They have to declare that registration statement effective before any shares can actually be sold. And there might be state-level filings, too, and things with the NASD, the National Association of Securities Dealers. It's quite bureaucratic.
Right, lots of hoops to jump through. So once the regulators are hopefully happy, how do they actually prepare the shares for sale?
That brings us to the underwriting and marketing phase. The company picks an investment bank to be their underwriter. This bank basically agrees to buy the shares from the company and then resell them to the public.
So the bank takes on some risk?
They do, and the underwriter is absolutely key here. They help figure out the price, decide who gets shares initially, and really market the IPO, build buzz. They pitch it to big investors.
And then finally, the launch. Launching the IPO, what happens then?
The company and the underwriter set the final share price, they allocate the shares, and then often the other. Well, then the shares are offered to the public. Trading begins on the stock exchange. It's a huge day for the company.
But it's not over then, is it? The work doesn't stop once trading starts.
Not at all. That's almost just the beginning of public life. Post-IPO, the company must keep meeting all those demanding regulatory requirements. Ongoing reporting, compliance. It's a continuous commitment.
So that's the traditional IPO route.
Yes.
But you mentioned alternatives earlier. Can you remind us what those other paths are?
Sure. There's the direct public offering, or DPO. That's interesting because the company sells shares directly to the public without an underwriter.
Cuts out the middleman.
Pretty much. It can save on fees, but the company has to do more of the heavy lifting on marketing and distribution itself. Then there's the SPAC, the Special Purpose Acquisition Company.
Right, the blank check company.
Exactly. It's a shell company that's already public. It raises money, then merges with the private company, and boom, the private company becomes public through that merger. That's called despacing. And one more is a reverse merger. That's where a private company merges with an existing public shell company, maybe one that's not very active, just to gain that public status.
Interesting. So several ways to get there. Okay, let's flip the coin now. Can a public company actually decide to go back to being private? It seems like a massive undertaking to go public in the first place.
Oh, absolutely they can. A public company can definitely decide to transform back into a private entity. Maybe their strategy changes or the market conditions aren't right for them anymore. How it usually works is a major shareholder, often a private equity firm, buys up a huge chunk, maybe all, of the public shares. Then they request the company be delisted from the stock exchange and deregistered with the SEC.
Why would they do that? After all that effort to go public, what are the reasons for going private?
Well, there are a few strong motivators. Sometimes it's simply wanting fewer investors, a smaller, more controlled group. Sometimes the buyout itself offers a nice payday, a financial gain for the existing public shareholders. But a really big reason, often cited, is just escaping those heavy regulatory and reporting requirements we talked about.
Getting off the quarterly treadmill.
Exactly. Many CEOs feel that intense focus on quarterly results forces them into short-term thinking. Going private lets them focus on longer-term priorities, maybe riskier R&D, without worrying about the stock price reaction this quarter.
That sounds like a huge relief for management, potentially. But surely there are downsides, too. What are the risks of privatization?
Oh, for sure. It's definitely a trade-off. Those new private owners, especially if it's a private equity firm, they might impose really strict business goals and very tight timelines. It can be a different kind of pressure cooker.
Right, maybe just swapping one kind of pressure for another.
Possibly. And there can be internal disruption, too. Employees might face layoffs if the new owners decide to restructure things to meet those goals. And crucially, once you're private again, you lose that easy access to the public capital markets. Future growth has to be funded privately, which might be harder to find or come with tougher terms.
That Dell Computers example you mentioned is fascinating. They went private in 2013 for, what was it?
$24.4 billion. Michael Dell and Silver Lake Partners took it private. A massive deal.
Yeah, that really highlights the scale and the strategic thinking involved in these kinds of moves.
It really does. It was a prime example of a company choosing long-term strategy over immediate market reaction.
So pulling this all together, for you, the listener, watching these companies, seeing these headlines, it really hammers home that deciding to be public or private is a massive strategic choice, right? It's all about weighing different priorities.
It absolutely is. And if we think about the big picture, the key takeaways from our dive today are pretty clear. First, that fundamental distinction is everything. Public means broad ownership, exchanges, SEC oversight. Private means limited owners, fewer disclosures. Second, the regulatory burden. It's huge for public companies, all about investor protection, transparency. Private companies get more operational flexibility, less scrutiny.
Less scrutiny, but maybe less access to easy money, too.
Right. Then we saw the IPO as the primary path to go public. It's common, but really complex. And ultimately, this whole public versus private thing, it's a strategic choice, driven by needs for capital, desire for control, how much regulation you can tolerate, how you want to deal with investors. And finally, the trade-offs. Going public gives you access to capital markets, but brings intense reporting pressure. Short-term focus, maybe. Going private offers more control, less burden, but cuts off that public funding stream.
So we've covered a lot of ground. The definitions, the regulations, the complex journeys companies take between being public and private. It's clear these aren't just, categories, but really fundamental strategic decisions that shape a company's future.
And it leaves us with a really interesting question to think about, doesn't it? In today's world, which seems to value transparency more and more, where's the right balance for companies? That balance between the benefits of public money and the desire for private control, for that long-term vision. It's something to keep in your mind if you watch these corporate shifts happen. They really do impact innovation, jobs, and the whole economy.